Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsors and deal-by-deal entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's conversation is with Logan Walters of Forge Equity. Nicholas, what was the takeaway you had from our conversation with Logan?
One of the things that is different about Logan's model is that they prefer indefinite hold periods. And every now and then we interview independent sponsors who prefer the permanent hold, with a pragmatic eye towards the hold period, of course, if something crazy and spectacular should come up. But in general, they prefer a long-term indefinite hold. And so we asked him questions about this. And one question we asked was, of the various investors that exist out there, what are your observations with regards to how they perceive the indefinite hold? And so he interestingly said that family offices quite like it, but high net worth individuals are a little bit more hesitant about it. And this jives with my intuitive feelings around it, because for a family office, their job is to put the money to work. So if you return the capital, they need to find another place to put that to work. They'd rather just have it stationed in one place. It's more tax efficient, and also it enables them to focus on the other surplus cash that they have to invest, right? Versus for a high net worth individual, if you give them a win after 5 years, that's an opportunity for them because they get money back that they can deploy into their life and buying a second home or whatever. And it's also an opportunity to invest in the next thing that they now have their eyes towards. So the dynamics there are quite different, right? And so I found that interesting how he had seen that very clearly, given that he raises money on a permanent basis. It's also a contrast to what we do at Minds Capital, where we raise for more of a definite hold, right? We have a fund with a definite fund life, and we see a lot of interest from high net worth individuals. So that part of it jived with what we've seen. I also asked him, if you rely solely on dividends for returning the capital, what makes for a good dividend payout? Because, if you've invested $200,000, you're not going to want to receive $1,000 checks, do you? And he kind of resisted my thinking there and said, no, any dividend amount is a good dividend amount. They always appreciate getting some money back. And he specifically said, if you give them 5% back, that feels good to them, especially if it's relatively early on and can meaningfully move the needle. Where my assumption perhaps had been that, of course, it's not negative to give the money back, but if you, instead of giving them back just a couple of $1,000s, if you have good ways to invest that and grow faster, as an independent sponsor, that's often where you will lean. You have so many other uses for excess cash flow. So his perspective anyway was that any dividend amount is a good dividend amount, and even a small amount can build some goodwill with those investors.
Nicholas, your mention of the permanent hold is slightly unusual, although we do see that. Another slightly unusual thing that we heard from Logan was about their STS deal and how it was an all equity deal. And that we really don't hear about that very much. Of course, the LBO model has L right there in the title. But they did an all equity deal, and they did it because of the volatility of the business. And in retrospect, they were really wise to do that because, in fact, the business, the EBITDA cratered to zero in their first year of holding the business. And so they ended up scrambling to turn it around, to save the business, which they did, and then some. I mean, it's done very, very well since. They're up to $50 million in revenue. A number of years later, they've returned, I think, 30 to 40% of the capital to their investors in that deal over the 4 years they've held it. We discuss what it would have looked like if there had been leverage on the business and how dire it would have been. It was dire anyway, but with leverage on top, it would have been much, much worse. So pretty interesting case study there. Max, any thoughts on our conversation with Logan?
It was an interesting case study. And I was here in Houston. I live here in Houston. We're fellow Houstonians, obviously, Logan and I. And I remember that storm, that derecho that ripped the roof off the STS facility, as he said, which was housing some electronics that they're recycling. And that business is not just, take those things apart and sell them for scrap. It is that in some cases, but sometimes it's just, tune it up and actually resell the device. So if you've got electronics sitting in there and the roof gets ripped off and rain gets all over everything and you just bought the business, that's a huge problem. Certainly less of a problem, I think, if you are all equity. And I think it kind of speaks for itself. If you don't have debt on a acquisition, you're taking a much less risky approach. And if in the event of something like a, roof getting ripped off and all of your inventory getting ruined happens in the first year, you have a lot less downside to worry about because you don't have that monthly payment and interest and a lender that has to be paid back. You've got flexible equity investors. But at the same time, of course, if you're going to go all equity, your returns are going to be most likely a bit more limited because you just simply don't have the leverage to engineer that return for equity investors. So, it's a cost benefit of whether or not to have debt or equity. I think the right question is just, for me, in most transactions, is what's a reasonable amount of debt that supports this transaction that yields us the best return with, the risk that we can tolerate. And so in some cases, it makes sense probably to go all equity. And that might be aligned with, of course, limited partners who have more capital, who have a lower cost of capital, who are generally looking for safer, sort of more perpetual returns, but ones that kind of beat the standard, public markets usually. So I think it's just all about investor alignment and what's your capital looking for in terms of a return. And that's that leverage that gets you that engineered return and honestly makes you more competitive, I think, in the acquisition process, because you can obviously afford to pay a bit more if your cost of capital is a bit lower. So I think if you're also going all equity, it's got to be a special situation. Maybe there's not as many bidders for the asset. There's more risk. There's more cyclicity on that asset, but you could still get a decent return if you do go all equity. But when you're in a more competitive process, you're going to have some level of leverage probably to compete for the asset.
Well, let me just also chime in on this, because the all equity discussion is interesting to me. In Fund 1, I think out of 16 platforms, 3 of them were all equity, meaning no debt. 2 out of those 3 were buy-in builds, and I think we increasingly will see buy-in builds be all equity, because you raise first a pool of equity to do a lot of transactions, and then your idea is to raise debt for acquisition 4, 5, and 6 once you've built a little bit of a balance sheet. I'm generally an advocate of strong balance sheets and not a lot of debt. And I like the conservative approach, both in general, but especially as an investor. But there are some downsides here also. And so let's talk about that. It makes your fundraise harder because you need more equity. And that equity is now underwritten to no debt. So in order to get a 3x return on that equity, you need to achieve more growth. So your fundraise is going to be longer. Of course, the equity is diluted because it's a lot more of it versus if you only had to raise 1 or 2 turns of EBITDA. Now you have to raise 4 turns of EBITDA of equity. So that dilutes the equity, even if it makes the risk profile better. And also, I would say for a deal that is flatlining or going down a little bit, it can be harder to raise debt in 1 or 2 years if you need liquidity versus if you had debt from the get-go and you need to raise a little bit more cash to keep it going and to grow. The equity investors might be more amenable to a creative or unconventional narrative that may exist at that time versus a bank lender who will be iffy about coming in to a questionable performance. I will also point out, having been in this space for a long time, it's not too often that I hear leverage be the culprit of a deal going under. Of course, it's a piece of the puzzle. You hear about it in self-funded search land sometimes because they lever it up to 90% with SBA 7A loans, which is highly levered. But for independent sponsors, they raise 2x EBITDA, maybe 2.5, or maybe even 3x of EBITDA. But generally speaking, that's not a lot of leverage compared to middle market and large market PE who raise 6 to 8x of EBITDA in debt. This is pretty conservative. And that debt often comes from SBICs who also have an equity sliver into the cap table. And so they have aligned interests, they sit on the board, and they have an eye towards the equity story and the management's perspectives, not just the covenants. So I think the discussion on whether to raise debt or not is always nuanced. There is no black and white answer on whether you should do it. It's a case by case.
I wonder if there is a pattern to be drawn from revenue volatility. If all equity is more common in businesses where that's a feature of the business, and that was exactly what Logan had seen from the outside, that this was a business where there was going to be that volatility. So I wonder if there's if there's a correlation there in general, despite the fact that every deal has its own idiosyncrasies.
I mean, I think there certainly is, and if you have a deal that you really love but has revenue volatility, but you believe in the long run that it's very viable and that you can grow it, but you're going to have these periods of volatility in the meantime, then obviously not having much debt or having no debt could make a lot of sense for those down years. But then I think you got to look at the whole picture and obviously the whole potential return for that investment. If you're going up and down, but you're still going up and you have no debt and you get a 15% IRR at the end of the day, oh, well, how does that compare to something else that you could have done? I think that's the scorecard at the end of the day.
Great. Well, before we turn to the interview with Logan, a reminder that at Minds Capital, we invest equity into independent sponsor-led acquisitions. Our check size is $1 to $3 million per investment, and we average about a commitment a month. So if you're a sponsor raising equity for a platform acquisition, submit your deal to us at mindscapital.co. Or if you're interested in investing in Minds Capital as an LP, also on our website is a pre-registration form for investors. So if you're accredited or can become accredited, fill out that form to be kept in the loop on future raises. Again, the URL, mindscapital.co. And here is the Minds Capital podcast interview with Logan Walters of Forge Equity. Enjoy. Welcome to the Minds Capital podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James.
Newly acquired and PE-owned companies are high-value targets. Hackers time their attacks when teams are distracted by the deal, exactly when a breach can stall operations, bleed cash, and blow the thesis. Inzo Technologies is your full-service IT MSP for post-close stability. They assess your target, surface the biggest risks in plain English, and give you a day 1 through 30 plan to cut exposure, prevent downtime, and even find cost takeouts like bloated telecom bills. Check out inzotechnologies.com, INZO, or email CEO Nick Akers directly at nick@inzotechnologies.com. Having acquired Inzo himself, Nick understands the challenges sponsors and searchers face when transitioning a business. So make sure to tell him you're an independent sponsor and listener of the Minds Capital podcast. nick@inzotechnologies.com.
Houston-based Logan Walters founded Forge Equity in 2021, a buy and hold independent sponsor with 3 portfolio companies today and a 4th under LOI. A Rice MBA, Logan worked at SCF Partners, a PE group focused on oilfield services. As an independent sponsor, Forge values a strong partnership with their management teams and working together on a number of initiatives in the companies. Also differentiated in their model is this strong preference for indefinite hold periods. We're going to get into that. But Logan Walters, welcome to the Minds Capital podcast.
Thanks, Will. Appreciate it.
So, Logan, after a career in traditional private equity, you prefer the indefinite hold as an independent sponsor. Say more about that. Why? I mean, independent sponsors are receiving most of their rewards from investments in the interest from exit proceeds. So square that circle.
Yeah. So I started Forge with my partner, Gardner Dudley. And, when we were staring at our blank sheet of paper and thinking about what we wanted to do, the thing that kept rising to the top was really focus on building good companies, that above all else. Coming from institutional private equity, you run into the problem that all private equity funds do, which is we're going to sell our best companies and continue to work on the ones that are underperforming. And I always ask the question, why sell your best ones? Why not reap the cash flow from that? And so when Gardner and I came together, we just said it would be really nice if we could have an open-ended time frame to build great companies. To your point, we recognize that's deferring our own personal wealth creation because we're not exiting companies every 5 years. It's going to take us longer to reach the 8% hurdle rates that we have, just like every other private equity firm or independent sponsor. But we're willing to do that because we think it's the right thing for the company. And When we looked around at a lot of family offices, a lot of their wealth came from building companies over long periods of time. And so you have a model that shows you that if you compound capital, you're going to create greater wealth in many cases over a long period of time. And so that's really the crux of it.
And when you took that mandate or investment philosophy to LPs, to your own capital providers, how did they respond? Because oftentimes the reason the model is what it is, the traditional model, is because LPs need to see their money back.
Yeah, so there were two responses. One, from family offices that did generate an enormous amount of wealth from an operating company that was held through multiple generations, said, that makes a lot of sense to us. That sounds great. The second answer was from LPs who, didn't come from that kind of wealth, or maybe smaller investors who were more familiar with the traditional private equity model, which was, buy, build, exit in 5 years. And we just pointed out to them that Gardner and I would be deferring our own wealth creation until we did get an exit or returned a substantial amount of capital to those investors. So our interests were aligned. And there was no way that Gardner and I were going to make a lot of money without our investors making a lot of money. And so once they saw the alignment there, the economic alignment, they felt comfortable. And I want to point out too, Will, just because we have open-ended LP documents that allow us to hold an investment indefinitely, it doesn't mean we won't sell a company. Sure. We would sell opportunistically. And we're open with our management teams about that. We're open with our investors. So it's not a commitment to locking up your capital for 10, 12, 20 years. We're just saying we want the time to build this the right way. And then if an opportunity comes to sell the investment that makes more sense to us, we'll do that.
Logan, we've had a number of sponsors on here on the podcast who have evergreen, permanent, indefinite hold models. I don't know if it represents a trend, but it's not as much of an outlier as you might think, given that it is kind of a departure from the traditional private equity model. So, two questions. Do you see your colleagues, other independent sponsors, pursuing this model more than maybe you would have guessed? First question, and then I'll do a follow-up.
Yeah, so I haven't talked to all of them. I think a lot with private equity funds and funds that are focused exclusively on backing independent sponsors, having 5-year time horizons, 7-year time horizons, whatever it is. I think there's still a lot of independent sponsors that subscribe to that model so they can raise capital from those parties. The flip side is, if you can get LPs to commit to an open-ended time horizon, you're not really giving up anything. Your hurdle rate's the same. Your promote's the same. All you're doing is giving yourself as an independent sponsor the option to hold the business for a longer period of time. You still sell it in 4 years and make a great return, and you're going to be in the same economic position. So, whether they are or aren't, and the reasons they may or may not be doing it, if you can get it, you're not really giving up anything. I mean, it's kind of like the fund versus deal by deal investment and the carried interest argument, right? If you raise a fund and you have 5 investments and, you exit the first 3, you may still not be into your carried interest payouts. If you're an independent sponsor and you make 5 investments and the first one hits, you're in the carried interest on that right away. And so why not have that option? The flip side is you don't have the capital locked up. But, my view is in both cases, if you can get it, take that option.
And great. And so then my second question would be on that if you can get it. For sponsors who are listening who are attracted to that, to the indefinite hold and finding supportive or aligned LPs, capital providers, what is your sense of the appetite for that? You've explained to us the argument that you made and how you were able to convince the LPs that you did. Do you feel like capital providers that could be on board for such a model are hard to find, or no, not necessarily? They're out there. You just got to know you just got to position it the right way that aligns with their interests and knock on a few extra doors.
There's a great book by Michael Lewis, and one of the quotes in the book is, people don't choose between things, they choose between descriptions of things. And so I think if you go to a group of investors and you say, we want a long-term open-ended fund because we just don't know what's going to happen here, it's going to be pretty hard to sell that, right? Gardner and I very genuinely, I said from the blank sheet of paper, can look investors in the eye and say, we want to build a really good company that's going to generate great returns for you over time. We just don't want to be forced to exit it in 5 years. And I think the investors understand that. They can see that we're genuinely interested in that approach. And look, we can also explain to those investors, it gives us an advantage sometimes when we're in a competitive process, right? Because we can look at the owner of a business who's really proud of that business and cares a lot about his employees and say, we're not just going to flip this in 5 years. So, we're not going to be the highest bidder here, but we're going to be your buyer of choice if that really matters to you. And so that can give us an advantage there. And likewise, in a 5-year cycle or a 6-year cycle, I came out of oil field services. It's incredibly cyclical. If you're in a bad period, a COVID period or something like that, where it's tough to exit and you're forced to exit, that hurts the investors. Sure. So there's a lot of reasons you can give investors to subscribe to this. Now, if it's a private equity fund that's raised institutional capital and they've said they're going to give the capital back to those investors in 5-7 years, there's not much they can do. But for family offices, I think if you can be genuine about it and talk them through the benefits, and if you genuinely are interested in that, it comes through. It's called The Undoing Project.
The Undoing Project.
It's Michael Lewis's book, The Undoing Project. I'll look it up to be sure, but double check me on that.
Hey, how does the indefinite hold period affect the pitching with the business owners on the front end? Because on one hand, I can see it's beneficial in the sense that, their legacy will be long-term with one owner and they hand select you right away. But does it affect, for instance, how much they're willing to put into rollover equity if they don't see that next stage and next bite of the apple sooner?
Yes, Nicholas, we do deal with that a lot. And so if you have an owner who is really interested in, let's say they're a little younger, maybe just to take a case study, and they're interested in getting distributions and having distributions for a long period of time, they may like the fact that we're not going to exit the business and they really care about the business like I just talked about. On the other hand, we have had some owners who said, look, I like the model, but I don't want to be stuck in this for 10 years. And so we've actually crafted exit plans for them with guaranteed buyout provisions under certain criteria, at certain levels. And so you can build into the purchase agreement the right to buy them out and the kind of a put option for the owners as well.
You mentioned that the dynamics are different for younger business owners. What specifically did you mean by younger, and what would you say are the age cohorts as it comes to sellers, and how do they behave differently in these cohorts?
Well, and I say younger, it's not necessarily fair to classify by age because we can have an older owner who just likes the idea of owning a piece of their business for a long time, and a younger owner who says, look, I want to go do something else. So I want all my cash out in 3 years, after closing. I would say though, generally, if we are talking about age, a younger business owner that exits, unless they're exiting for just an enormous amount of money, generally will want to go do something else. So they want to kind of take their capital at some point. An older owner who's in retirement age or past, you get a lot of business owners who are in their 70s and older. Once they decide to exit, if you ask them to retain a lot of equity, they kind of want to know how they're going to get that out because they'd like to use it. So that's probably the split.
But let's dig into this more then. So when you're talking about someone younger, you're not talking about a 23-year-old here, obviously.
No,
so
I would say...
What would you characterize as younger?
Yeah, younger would be 40s to 50s. Old, those who are more interested in an exit are probably north of 60.
Okay, got it. Okay, so the break point is really 70 as you see it, from where they go to being curious about what will happen next, maybe a second bite of the apple, versus above 70. Let me get it out of this asset now and diversify from my personal life.
The break point would also be retiring for good or not.
Yeah. or going to do
Right.
something completely different. I want to support my kids in doing something, so I'm going to invest behind them. So it can be a lot of different things. I probably, splitting it out by age is a massive
Of
oversimplification.
course.
Yeah.
Independent sponsors need a legal team that understands the model and knows the players. Platt Richmond, a Dallas-based boutique law firm, has deep experience in guiding independent sponsors through the complexities of their acquisitions. The team at Platt Richmond provides support on all aspects of your transaction, from structuring and diligence to financing and securities compliance. They also represent stakeholders throughout the ecosystem: capital providers, lenders, family offices, sellers, management teams, which gives them a unique 360-degree perspective on the sponsor model that ensures a seamless process for your transaction. Partner with Platt Richmond to focus on what you do best: finding and executing great deals. Visit plattrichmond.com today to learn more. That's Platt with 2 T's, Platt, Richmond.com.
Logan, we talked about the 3 companies in the portfolio. We're going to have the treat of hearing about a couple of those today. Let's start with STS.
Yeah, so STS Electronic Recycling was our first investment. It's an IT asset disposition business, ITAD business. And so they take used electronics and recycle or refurbish and resell those. And so when we were thinking about our first investment, we looked at a couple of different themes, and ITAD was one theme that we liked. We liked it because as we dug into the industry, it was very fragmented. A lot of the businesses were kind of mom and pop business, run pretty simply, effectively, but simply. And it had really good tailwinds. I mean, we're not using any fewer electronic devices as we go forward. There's increasing regulation around this and increasing pressure on OEMs to deal with the waste stream they're creating. So we liked a lot of those things. Looked at a couple of businesses, called on STS, happened to talk to them at the right time. 3 owners, and they'd started the business and were open to bringing a potential partner in. So we invested in that business in March of 2022, and I joke that one of the only things we did right when we bought into this business as partners, we bought 51% of it, was we told our investors that we felt like there was a lot of upside in the business through growth and operating improvements. But that there was also potential earnings volatility. And so we didn't feel like we should use any debt in this investment. So it was an all equity investment. We unfortunately were proven right in that the first year of the business in our ownership did 0 EBITDA. That was not the investor case, as you might imagine. So we dug in with the management team, and Gardner and I, just our approach is not to go in and yell at people and scream at them and tell what they're doing wrong. It's really to dig in, get in the foxhole with them, and really work with them. And Gardner is a very experienced executive leader, strategist, operational leader. He's got a lot of experience there. It's why we're good partners. And so we dug in with that management team, and to their credit, they were very open to feedback, input, suggestions. And so we got the business turned, and in a case that we're really proud to point to and grateful for, the work of a lot of people, that business beat its budget last year. So that would be 3 years, roughly, and almost 4 years into the investment, by over 20% on EBITDA. The business, since we invested in it in 2022, it did just over 25 million of EBITDA. This year, the budget is for over 50, so it's doubled. The EBITDA has grown commensurately. We've generated, quite a bit of cash out of the business, and we bought out one of the original investors. So we've increased our ownership in the business. We've successfully grown the business, and we've distributed our investors around 35 to 40% of their original capital back to them, and still own more of the business. And at the original investment multiple, it has a very healthy return, and we're likely to see multiple arbitrage from that based on where companies are trading in the sector if we sell it. So it's a good story to point to, but I really want to be quick to credit the team at STS. They've done a great job. They stuck with it when times were tough, and just really grateful to have the partners we do in that business.
A few follow-ups. What a story, first of all. Did I hear you say 25 to 55 of EBITDA?
That's correct. No, that's revenue.
I thought I heard EBITDA.
No, 25 million of revenue to 50 million of revenue.
And so the volatility in this industry comes from what? I would think that there'd actually kind of be a regular cadence of decommissioning electronics, buying new, and that it would actually be pretty regular.
It is for the most part, but you can see, and we did in 22, we saw some kind of an increase in the amount of product on the market, which depressed prices a little bit. That was not the only reason for the issues. We had some internal issues, and Gardner and I probably should have been a little closer to it than we were. But the management team, to their credit, raised the flag. And when we showed up and started digging into really your, hour by hour economics of how many times you touch a piece of equipment once it comes in the doors and before you sell it, they were really open to that. And so it allowed us collectively as a team to really get a deeper understanding of the economics of our business, and then to make better decisions. And that's what really turned the business. We're now much more informed about just the fundamental economics of that business, and we're able to deal with other issues. We made a very small acquisition in Houston, and it had a boomer first month, and then the second month, we had something called the derecho come through Houston. Mm-hmm. The derecho is a huge windstorm. It ripped the roof off the building and dumped a bunch of rain on the electronics that were sitting in the building in Houston, literally a month after we invested in the business. So what did you do? Well, we just accelerated our kind of consolidation efforts to move everything up to Jacksonville, Texas, or all the sorting and a lot of that. And, it's turned out great. It was a really painful month. A month before we invested in STS, they had a fire in one of their buildings, and, a big fire. And so you're going to deal with these things if you invest in businesses. Anybody's thinking about being an independent sponsor or investing in a small business or a medium-sized business, it just comes with the territory. So you got to be resilient and focused. And, I'll go back to it. You really have to work with your management teams.
And so when it dropped to zero of EBITDA, your fix was actually was operational improvements, it sounds like.
Yeah, it was really getting into the detail of, if you think about this business, we take in product and then we decide how many times we're going to touch it or how much we're going to pay for it. And then we either sell it to scrappers by weight or sell it wholesale or sell it retail. We're very familiar with the exit pricing in all of our channels, and it's easy to track. And so if we understand that, and we understand how much we pay for something on the front end, then it's just a matter of understanding how many times you touch it and how much you put into it in between. And so once we, frankly got spreadsheets that really exposed all that, we immediately started making better decisions about things. And so there's a lot of other things that the company and the team have done, but that was the first step, was really understanding the structure inside of it.
And do you remain as bullish on the overall macroeconomic tailwind to this business, the trend?
Oh, far more so. With all of the data centers that are coming up, all the increasing investment in AI, all the need for electronics, different electronics, more powerful electronics. I mean, absolutely.
Yeah. Can you walk us through what would have happened in this situation if it wasn't for the fact that your deal had been all equity?
I mean, it's going to be a short conversation. If we had $4 million of debt from a commercial bank, it would have been some difficult conversations. And
Yeah,
we might not own the
that
business
part is
today.
obvious. Yeah, but that part is obvious. But a commercial bank is not going to want to step in and take over a business without a roof where there is water on all the electronics, right?
Yeah.
So, like realistically, you've been in PE for a long time? How does that workout happen step by step?
So fortunately, I've never been through a workout scenario, even in oil field services going through cycles. And it comes from really a couple of things, Nicholas. One is conservative use of leverage. We didn't use any in this case. And then also significant communications with the bank around what's going on and how you're going to fix it. And then following through on those commitments, whether it's putting equity in or trimming down the cost structure of the business. I would say that most likely we would have ended up owning a lot less of the business and working with the banks to work something out. But what it would have taken away unquestionably was the cash of the business to reinvest in itself and do the things that we've done. And so we'd be far, far behind where we are today if we'd had debt on the business. And that's not to say that you shouldn't have debt on businesses, just to be clear. At our rental business, we have a large rental fleet. I mean, that can't be an all equity business. It's impossible. And so you got to use the right amount of leverage. And it just so happened in this case for this business, the right amount of leverage was none.
Logan, you talked about how well is doing today and, what a theoretical exit multiple expansion could be if you were to sell, not that you're looking to, going back to the long-term hold. But it's interesting now. Let's hear now, like how you do think about this investment, given that you're on the other side of kind of the worst point. It's rocking and rolling, throwing off a lot of cash, already returned 40% of the initial investment to investors. How do you, when you have an indefinite hold like that, but also one that you recognize that you could capture a lot of gains were you to sell it tomorrow, how do you think about the plan for the next, say, 5 years?
So it's a really good position to be in, Will. I had a conversation with a former private equity executive earlier this week who's an investor in this business. So he comes out of private equity, used to the big wins and liquidity. And I talked him through our options. And those are, we have been approached by some strategics and others, just interested in the business. We haven't pursued any of those yet. But one option is we sell the business and make a great return. That option is in front of us, and until the market changes, will continue to be in front of us. Alternatively, as the EBITDA of the business grows, as the cash flow of the business grow, we should be able to distribute really, really nice cash distributions on an annual basis, provided we don't go make an acquisition or do something else. And not having any debt on our balance sheet also allows the opportunity to do a large recapitalization or sell a part of the business to new equity holders and distribute that cash to our old equity holders. So, as I walked him through all these things, he said, this is great. We have all kind of green light options in front of us at this point. Not to say something couldn't change, but it's just a really good and comfortable position to be in. And for the record, we haven't had one investor come to us and say, well, geez, why don't you sell this thing for, a 3 times return this year? I mean, they're all kind of like, look, we like, 20 to 30 to 40% annual distributions if you can keep making them.
And just curious about the business itself. Does it service essentially local or geographic customers?
It does, Will.
And
because you're transporting electronics, there's a logistical cost to it, and there's weight. And so you kind of operate inside of boundaries. You can have satellite collection points that then consolidate and then transport to a central hub. That's kind of the way ours works. Others work a little bit differently, but yes, we're geographically focused on Texas largely, but we take in product from different places, and we actually have a hub in Miami, so we do Florida as well. But the logistical aspect is going to create kind of a circle that you work within.
And I haven't heard you mention inorganic growth much. You had that one acquisition, but is that because if you kind of attack the market and with sort of a roll-up consolidation strategy, a strategy like that usually necessitates a timeline and implies an exit?
I think that for us, it's more of we have a formula that's working well, and we see organic growth ahead of us, and it fits the team, it fits the company, and it's a pretty low risk approach to continuing to generate cash in the business and build equity value. And so for now, that's the approach we're taking. We have explored some larger acquisitions for various reasons. It just wasn't a fit, but we'll continue to do that. We look at potentially large acquisitions all the time. It's nice to have a clean balance sheet and a good amount of cash to be able to explore those.
Well, it's also great to be in an industry that has the tailwinds are so strong that, fragmented though it might be, the inorganic consolidation strategy is, not the priority. I mean, that's actually quite rare, it seems like, in our world.
Definitely not what I was doing in oil field services. A lot of buy and build there. So
yeah, exactly. I said that we were going to be able to hear a couple of stories out of you today, Logan. You have another portco which is doing really well. We heard you say data center related to STS. This second one is also benefiting from the growth in data centers, although in a very different way. Let's hear about Axis.
Yeah, so Axis Rental Solutions is a rental company that focuses on industrial rental equipment. So think man lifts, forklifts, light towers, air compressors, that type of equipment. It's based in Houma, Louisiana, and was purchased by our current partner in about 2018. He made an investment in the business. He is a multi-time entrepreneur, successful entrepreneur. He's from South Louisiana. He has built a large rental business before. He started in a rental business decades ago, cleaning out hoses. And so he's done every job in a rental business. He's built his own rental business. He's built other businesses. And he had built this business to a point that he was looking for a partner to come and put capital in to help him continue to grow the fleet because of the opportunity set he saw in front of him. He's in his 60s and said, look, I want to do this and I want to grow it. And I have a really strong second in command that I hired a couple of years ago. And so we've got a good team. And then there's a couple other folks we're grooming, particularly one at the company to continue to grow it. And, I'm looking for a partner that will help me really build this business. And so we looked at Axis and we said, okay, what do we see here? We see a really, really strong entrepreneur with a good second in command. We see a really good market that's benefiting from growth in LNG, shipbuilding, general industrial, as you point out, data centers more in the north of the state, which is creating pressure for equipment and people and kind of drawing things up from the south. And we see an opportunity to invest in a business that our investment will go towards the equipment that is needed to grow the business. And so, Gardner and I kind of laugh. He asks really straightforward questions sometimes, and he looked at me as we were evaluating this and said, do you think we can raise money for this business? And I said, well, we've got an entrepreneur who's done this before. He's rolling 80% of his equity forward, and he sold the last rental business, and this is generally public, for like over $100 million. If we can't raise money for this, you need to find a new partner. And so it was just kind of the perfect deal. And he's been a great partner. Our second in command, the whole team has been fantastic. They are receptive to our questions around what's the return on this equipment going to be? Hey, we need to see this. They embrace a lot of the analytics that we are trying to share with them about the business. Not surprisingly, in other independent sponsors will have experienced this. Entrepreneurs often know those analytics intuitively. They just don't produce them on a weekly basis and look at them. And he's no different. Intuitively, he knows his business better than we'll ever know it. But we're able to put some of that data on paper and help them look at it. They already had great reporting. They do a daily P&L at the business they send us, which is just phenomenal. And they were doing that before we got involved. So it's really a dream scenario, and the business has grown dramatically. That business, when we invested in it, we've been a partner in it for less than a year. And it was when we invested in that business, it did about $18 million last year of revenue. This year, the budget is for over 30 or approximately $35 million. And if
Wow.
you look at our investor case, which, I mean, we built almost this time last year, we had $35 million of revenue in 2031. And so,
Wow.
we've definitely added debt to the business because we've had to buy a lot of equipment, but to the credit of our leadership, the whole team has just done a phenomenal job in really putting equipment to work. And they scream at us most of the time because they want more equipment. And we're just saying, hey, look, we have to hold up a little bit. We've got to watch our debt levels and things like that. But it's fun conversations.
Logan, to your point about the investment being so easy to raise for because it seemed like such a strong deal, why did they choose you guys?
Well, so we started looking at this business in a competitive process in late 24, early 25. And you'll remember that was the time that tariffs were really coming out. And we were in the process and really looking at the fundamentals of the business. We were worried about tariffs. We were worried about that impacting our ability to raise money. But when we got down to the fundamentals of the business, we looked at a lot of their projects that they were working on, in their long-term projects that are not going to stop because of short-term tariffs, interest rates, and other factors. We looked at the management team and said, look, they've been through a lot of cycles. They can manage through ups and downs. And we looked at the tailwinds behind the business and just said, fundamentally, this is a sound business. And even though right now things are uncertain, we feel like we should press forward. And so we really stayed the course through the competitive process. And, we're front and center and didn't pull back. And other investors in the process did pull back. And they said, look, we're going pins down for a month or however long this takes. And interestingly, several of them came back after it was under LOI to the intermediary and said, hey, look, we'd really like to take another look at this. And they'd kind of missed the boat. And so there was a lesson there. It's not to say just put your head down and go, because there are reasons to pull away from a process. But I think we felt like we really understood the potential impact to tariffs in this business and felt like it was pretty muted. And also had a team that could manage through ups and downs. And so we stayed the course, and that was a big differentiator. Additionally, I would note, this is a business that the owner said, I want to do this for a period of time, and then I do want to exit. So Axis is not likely to be a long-term hold for us. And so we were able to align our primary investor, who's a large family office that will remain unnamed, but communicate that clearly to them, and they said, yeah, we agree. In this case, that's probably the right thing to do. So good alignment of investors on that.
And so the hold period here is kind of the traditional, or the play here is the traditional hold period?
Again, our documents allow us total flexibility, and it will ultimately be up to, kind of us in the family office and our partner in the business to make that decision. But I think our sense is, we can grow this. And if you are going to sell a business, you want to sell a business that has upside for the buyer, right? I mean, you don't really want to sell a business that's about to fall off a cliff. That's not a reputation we want. And with all that's going on in Louisiana, we feel like we can build this business, and there will still be a lot of upside left for a buyer, and we can make a good return. And that's a good transaction, right? That's the right thing for the business, the right thing for the buyer, right thing for the seller.
If you look at the dramatic growth you've experienced at Axis so far, how much of that is market-driven versus value creation that you guys have been responsible for since getting involved?
So I would really attribute it to two things, Nicholas. The market has been fantastic. It's been really good. To the credit of our leadership team and our CEO, they had the relationships to go take advantage of that. They have an excellent reputation in the market for taking care of customers, taking care of their equipment. It doesn't break down, taking care of their employees so employees stay. And so that was a major contributor. You can have a great market, but if you have a company that has a bad reputation, you might miss it. And we didn't. I think our primary contribution to this has been to ask the right questions and then help support the business financially through both equity and debt. So as for instance, we put a new bank facility in place at closing. We injected a lot of equity. We supported them. We had a clear CapEx plan. Everybody knew what to expect. I think the business also now, for sure, we have a very detailed budgeting process. And to the credit of the management team, they're hitting their budget. And so it's increasing our confidence that they're able to really project out what the equipment is going to do, accurately. And so what does that lead to? More capital. And we have a new bank facility in place now. We put our second one in place about 6 months into our ownership of the business. And it's grown dramatically. And so we have a lot of headroom and opportunity to continue to grow the business.
And so when it is market-driven, how does that affect things on the front end with valuation? And also you talked about investment horizons. Is that also impacted by, in this case, a market that will swing back and forth over time?
So, yeah, in terms of the valuation, there's always going to be the debate on what do you pay for today that's going to come tomorrow, and so you can structure earnouts or different things to kind of bridge those gaps. And we may or may not have used some of that in this deal. I won't get into the details, but there are mechanisms to deal with that. I think the second thing is, especially in this case, because the owner was rolling so much equity forward, there was a great economic alignment, and we really look for that in our transactions. We want really strong economic alignment, and it was perfect here. He's going to win. If we win, it's going to be great. And then in terms of the market, I think the biggest mistake that someone could have made here was investing in this business and then being really, really cautious about buying new equipment, buying $1 million of new equipment or something like that. That just would have strangled the business. They wouldn't have been able to serve their customers. So understanding what you were signing up for in the level of commitment, and then finding investors. This was really important. We had 3 term sheets from family offices, and we chose the one that we felt like had the biggest balance sheet, frankly, and was best aligned and was most committed to growing the business. And they've been a great partner in this business.
You said previously that your LP documents are open-ended when it comes to timelines, but that is my experience. In my experience, that is true for all SPVs and independent sponsor deals, that they don't actually define we are committed to selling this within 60 months or whatever, right? I think with funds, you would see that the fund has a 4-year deployment period and 10-year investment hold period and whatever. But on the SPV level, are there any differences between your legal documents versus the standards?
So I haven't seen a lot of other legal documents from independent sponsors, so possibly not. Maybe the difference is we're very open in our communications with our investors that we may hold this for an extended period of time, or we may exit it. And again, this is where we're raising money for our 4th investment opportunity right now. It's under a letter of intent, as Will mentioned early in the podcast. And we're being very clear with investors who have maybe 5-year time horizons that this may not be the investment for them because we may hold this longer. So we just try to be really transparent about our intentions. And so we can always say, even if someone comes and says, well, I want out of this thing, we can at least say, hey, look, we told you what the expectation was.
The deviation from the standard 5-year time frame, how do you find that resonates with investors, or which investors does it really resonate well with versus on the other side of the spectrum? Who do you get more resistance from?
So I think family offices that are interested in compounding their wealth and not necessarily looking to return it in this generation, for instance, are very, very receptive to that investment model. It's a little tougher with individuals who are, maybe, high net worth individuals that are really looking to return a multiple of their investment in, in their lifetimes in 5 years, that just want to spend it on something, want it for retirement, for instance, is probably a great way to frame it. Those investors do want a defined exit time frame. So that's really the split we see. But again, I think, Nicholas, we're generating credibility with investors, both potential investors and existing investors, through things like STS, where we are distributing cash. They're seeing that come out. They're seeing it as a very high yield on their original investment. And, all of a sudden, 4 or 5 years doesn't seem that long when you're starting to see these types of returns.
How big do dividend payments have to be to move the needle or be meaningful enough to actually do them?
So I learned from an independent sponsor a long time ago, who were a little bit mentors to us in this, that any amount is a good amount. There is a de minimis amount, 0.5%, that probably doesn't matter, but a 5% dividend ensures to your investor that it won't be a goose egg, right? It's hard money back. And so even if you're making small distributions to your investors, it means something to them. And they had gone through this and said, we were actually really surprised by the response of our investors to a 5% dividend 2 years in. But, it meant a lot to them. And it showed them that we were generating cash and we were focused on taking care of them.
Because in the public markets, you have to be consistent with dividends. Every quarter, you have to give the same, or ideally ratchet it up over time. It can be quite bad for your stock price if you ever cut into that or have one quarter where you say this is going to be a dividend-free quarter or half of the dividend, right? So in the public markets, it's not necessarily about the size, but about the consistency and growth of it over time. But in the private markets, the dynamics are different. And so you're saying 0.5% would be too small, but 5%, even at the 2-year mark, can be exciting and reassuring and also send a signal that the sponsor is in control.
I think that's right, Nicholas. And, as an alternative investment class, we avoid the classifications that you see in the public markets of, a dividend stock, a growth stock, things like that. And so those public markets investors are very intentional about investing in those dividend stocks. And when it doesn't pay a dividend, as you point out, it can see a drop. As an alternative investment class, there's a lot of different ways you can return capital to investors. I think the important thing is you're showing a track record of doing so.
One other argument against the dividend track that you guys put STS on, right, is that as sponsor, you have so many things you can use your excess cash for. Dividends for most deals is fairly far down on the list, right? Above it, you would have debt repayment, which in your case is all equity, so it doesn't apply, but you would have M&A. You've said earlier in this conversation that you're not too aggressive on M&A as a growth lever. It can be CapEx or reinvesting into the business, opening de novo locations, right? It can be augmenting the tech stack or the team. And so there are many places where the business can grow faster and ultimately yield a better IRR if you reinvest it versus giving 5% back after 2 years. Because 5% meaningful, sends a nice signal, but that might be $1 million or $500,000. And that can be quite meaningful if you're looking to upgrade this company. So how do you weigh that? And if you commit yourself to the dividend path, isn't that somewhat compromising the growth story to some extent?
So I think it's one of the advantages of thinking about building a business over the long term and communicating to investors that you may or may not exit a business in 5 years. There's a lot of the things you cited are used by private equity, maybe less in the best interest of the business, but because it it has the potential of compounding the growth to hit that higher return over a 5-year period, right? If I go do M&A, I mean, I was in a private equity shop that did very successful M&A and compounded and returned a lot of capital to its investors. But some deals, we clearly shouldn't have done, right? And so I think you can get sucked into those things sometimes with the capital you have available if you're staring at a mandatory exit in 5 to 7 years. The luxury of where we are is we don't have to do that. And so we can look and say, hey, look, the right thing for the business right now is not to do M&A, even though it's going to grow slower. But we're not worried about that 5-year exit. So it's okay. And so, instead, we're just going to go ahead and send that cash rather than sit it on the balance sheet. As you pointed out, we don't have debt. So rather than just sit it on the balance sheet, we're going to distribute that out to our investors, and then they can go do something else with it. So I think it's part of the benefit of our model is, we're not kind of forced into growing within a 5-year time horizon.
And the distributions or dividends, Logan, are if you make a distribution, does that commit you or not necessarily commit you, but do your investors sort of psychologically then expect to see more? Does it put you on a path, or can you do a one and done, one-off dividend and everybody's happy to see it, but it doesn't commit you implicitly or explicitly going forward?
So it definitely doesn't commit us going forward. We can change it at any time. No investor could come to us and say, well, wait a minute, you made a distribution last year. Why didn't I get one this year?
Sure.
One of the nice things about dealing with the types of investors most independent sponsors deal with, which are, wealthy families and family offices, is I had a conversation with one of them the other day and he said, oh, I saw in your investor report that y'all have now, distributed 30 to 40% of the original capital back. That's great. Did I get my distribution? And we said, yes, it came like several months ago. But do you want us to check and make sure you got it? And he said, no, I'm sure it's in there. But, and so, I
must be
right,
nice.
Exactly. I'd love to be there someday. I'm definitely not. I make sure my distribution check hits from the investment I made in that company, and I know exactly when it does, and I know exactly how much it is. But that's part of the folks that just different situation. So no, there's no commitment though.
Yeah. Okay. Logan, we only got you for a couple more minutes, but we've heard you mention Gartner, your partner, a couple of times. We know that partnership is something that you advocate to other sponsors or up-and-coming sponsors. Why don't you speak to that directly, please?
Yeah. So we try to be, what I would describe as good constituents in the independent sponsor ecosystem. And so that to us means, one, be open to meeting with any aspiring independent sponsor, spending time with them, sharing our knowledge. We have way more deal flow than we can handle. So we try to understand what other independent sponsors are looking for and send them things as they come across our radar. We'll send things to investors if an independent sponsor has something on our LOI, with an appropriate caveat if we don't know them that well, just to say, look, you need to do your own diligence. But we generally try to be good constituents in the ecosystem. And one of the pieces of advice that I give all aspiring independent sponsors that I meet with is have a partner. Gardner and I have a very complementary skill set, which is really, really helpful. I cannot imagine having gone through some of the difficult situations, at STS when we were launching Forge, the decisions we had to make around, how to value the business, negotiations, things like that. Just having a sounding board, having someone else in the room that you trust, that you can talk to, and you believe is intelligent and is going to provide good counsel is just invaluable. And so, it is absolutely probably the most important thing to me. I'll never forget, I was in, it was early days in private equity at the oil field services company I worked for. And there was a person that I'd known actually since high school who had gone to business school, the same business school I went to, Rice University, a couple years ahead of me, bought a business, and it was an actuators business for valves on pipelines. And I went out and visited him kind of a year or two into it, and he was literally like out of a barn. It was the worst looking company you've ever seen in your life. And then he built it up. It had ups and downs, and then he moved it into a more attractive location in Houston and kind of built a business about. And so I went back and visited him. This is several years later, and I said, "What's the toughest thing about this been?" And without hesitation, he said, "I have no one to talk to at my level to run things by." He said, everybody that works for me is good at what they do, but they're not thinking strategically. And he said, it's just ultra lonely. And I never forgot that. And it really influenced, Gardner was an ideal partner for so many reasons, but I'm just really grateful for that. And we always tell independent sponsors, I tell them, don't try to do it yourself. It's hard.
Well, okay, Logan. We hope that you'll consider Minds Capital for your future deals.
Absolutely. You're invited.
We do not have the same indefinite hold mandate.
Yes.
So as much as it resonates with me, it's not the same commitment we have with our LPs. So we'll need one of the ones that is more traditional, but would love to be considered and love to hear from you. And we thank you for coming on the Minds Capital podcast.
Thanks for having me. We'd love to have you as partners and really appreciate what you're doing for the independent sponsor community. Thanks, Will. Thanks, Nicholas.
Thanks, Logan. Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also, check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraises. See you in the next episode.